right, welcome everybody. This is going to be the first video out of the series of teachings I plan to give to you all. This will be an introductory video, basically talking about the foundation of the system, what it is to look for, what to not focus on, and kind of get you guys in the right headspace on what it is that you should be looking at in these charts. All right, so without further ado, let's get right into it. So something that's very important to note is, as a trader, we all make money off of trend. If you don't have a trend, you cannot make money, right? So the importance is that we are always trying to catch a trend, right? Now, if we kind of break that down into as basic as we can, all right, we need movement. We need one directional movement for us to make money. If we go to look at how candles print, so a bearish candle, open, high, low, close, and a bullish candle, open, low, high, close, okay? Every high time frame candle and every candle in general prints like this, all right? All bearish candles open, create a wick, expand lower, and close, and then vice versa, all right? Now, if we are looking to trade the expansion, because again, expansions is where the money is made. That's how we as traders make money. Then it's likely to say, okay, well, we want to catch this and this, all right? These are the expansions in these candles that we want to be catching, right? Whether you're an intraday trader, a swing trader, a short-term trader, okay? We want to be catching this. Now, what does this mean? Right? Well, if these are high time frame candles, that means this is the open, this is the wick, this is the expansion, and this is the opposing wick. Okay? So what this means is we want to catch entries at the wick of the candle we're trading or after the wick of the candle we're trading, because that's when it's going to be one-sided directional movement. Right? The same with for a bullish candle. We want to trade at the wick, whether this wick and this high time frame candle is a daily candle for low a day, whether it's a weekly candle for low a week, a monthly candle for low a month. Okay, we want to trade at the wick of this candle and after the wick of this candle, because that's when the expansion is going to occur. And that's how we can position ourselves to either catch the low and ride the expansion, or catch an entry inside of the expansion and ride it, all right? Now, because price is fractal, we can do this in a few different ways, all right? My personal favorite is the weekly candle, okay? So if we go to an hourly chart, most people see this hourly structure here, and they just see hourly up and down, right? They just see these candles. What I see and how I view it is all of this price action is embedded into a singular high time frame candle. Kind of think of this as the anatomy of a higher time frame candle, right? So this is the start of the week and the close of the week, right? So all of this hourly price action here makes up of a singular higher time frame weekly open, low, high, close, right? This entire hourly structure makes up a singular candle. The same way that if we go to a 4-hour chart and we mark the start of May and the end of May, all of this 4-hour chart, or excuse me, all this 4-hour price action here makes up a singular monthly candle here. Okay, so it's important to note this, because when we're looking to trade the trend, when we're looking to position ourselves to catch expansion, we want to do so at the wick of the candle we're trading or after the wick, right? The same way as if you were trading a daily candle for say. You know, maybe let's go to a random day. Let's go over here. Let's do this. If you were trading a daily candle and you mark out 1700, which is the open, to the close, okay, the best trades and the best expansions you're going to find are going to be at the wick of the candle or after the wick of the candle, right? Notice the consolidation and choppiness beforehand versus turtle soup, expansion, retracement, expansion, and then we close, okay? So part of this thought process is, again, we want to be catching the trend. The trend forms after the wick. Therefore, with just that idea in mind, we always want to trade, regardless if you're an intraday trader, a scalper, a weekly range trader, monthly range trader. You want to trade at the wick of the candle or after the wick of the candle, because that's when you can position yourselves and you can hold longer term and catch the actual expansion, okay? So now let's get into this a little bit deeper. So my personal favorite candle to trade is the weekly, all right? Reason being is it provides a good map out of what days of the week are likely to be the highest probability, okay? And let me show you an example of that. If we just go to this week, for example, we mark the weekly open and we mark the weekly close, okay? So I was bearish on this week. From this weekly gap, again, if we look here, this is a weekly gap. I was bearish on this week, okay? Now, if I'm bearish on a week, that means that I want to be trading at the wick or after the wick to catch the expansion, right? So in order to do so, I want to wait, and this is another thing that you want to think about. So when we're trying to anticipate wicks of high time frame candles, wicks of high time frame candles almost always form inside of high time frame levels, right? This is a good way to view accumulation, manipulation, distribution, all right, is based off of when do we actually tap high time frame levels for the manipulation to continue, all right? So that's how I base my process of understanding where do wicks form and when can expansion begin to occur, all right? So in this example, we had SMT on dollar at the high or inside the gap. We had an internal soup, an expansion, and then we had SMT at the low, all right? But for this weekly candle, again, and because price is fractal, I can break this weekly candle down into daily candles. Monday, Tuesday, and so on. Okay. Now, if we look at it like this, which days of the week were the highest probability in here to catch this directional move? It would have been Wednesday and Tuesday or Thursday, right? And notice, for everyone who traded Monday and Tuesday, it was very consolidative. Why? Because the manipulation hasn't been put in yet, right? Again, we want to trade at the wick and after the wick because that's when we get the true expansion. That's when we can take entries and we can hold versus taking entries and getting stopped or getting trapped in consolidation, right? That's what we want to avoid, okay? So understanding where the wick of the high time frame candle is likely to form, and then validating which days of the week are likely to give you the best expansions based off of that. Again, if I do this, if I mark a weekly candle, right? So let's say, for example, this is a weekly candle, open, close. If I'm expecting a bearish candle to print something like this, okay? If this is Monday, Tuesday, Wednesday, and then Thursday, Friday, okay? It would be likely that you should avoid trading Monday. Why? Because the wick of the week hasn't been put in yet. Then you seek to find entries where you expect the manipulation of the week to occur, which would be in the wick at the high time frame level. Or you catch continuations inside this Tuesday, inside this Wednesday, until we meet the opposing end of the range where the other wick is likely to form, in which again we would likely see consolidation. all right? This entire thought process is all about validating which days of the week are likely to be the best days of the week to trade. All based off of simply how candles print, right? All bearish candles print like this. They all print with likely a range. They open high, they create a wick and some sort of level. They expand, they create an opposing wick, and then they range again, okay? Understanding the anatomy of this on an hourly chart and then fractalizing that hourly chart into days of the week, understanding which days are likely to form the high or low, what days are likely to give entries that are sustained expansions, not short term, okay? That's how you can successfully catch trends and consistently catch them, right? And avoid ranges. That's one of the key things. A lot of people think trading is all about catching good moves, okay? Trading is about avoiding bad moves and growing capital, all right? Anyone can catch a good trend, but can you stay out of the ranges before that trend forms? Or can you stay out of the ranges after the trend forms, all right? That's the important part, and that's why understanding what days of the week are likely to provide that expansion is so important, okay? Now, that will kind of sum up this initial video just for the introductory. And again, just to summarize everything before I close off here, it's understanding that you always want to trade in the wick or after the wick of the candle that you're trading. Again, whether it's a weekly, whether it's a daily, whether even if you're a scalper, an hourly, okay? That will give you the more sustained expansion than trying to trade the range at the beginning of a candle, okay? And within that, how I personally do it within my own model, because I specialize in a weekly candle, all right? I'm looking for where is this week likely to print its wick, AKA its manipulation, and then I validate days of the week to trade based off of that idea, right? So if I have a high time frame level, I'm expecting a bearish candle to hit, and that bearish candle hits it on a Tuesday. That tells me that Tuesday, Wednesday, and then possibly Thursday, depending on when we hit opposing liquidity or targets, right? That tells me that that Tuesday, Wednesday, possibly Thursday are likely to give high quality entries because we're going to be in the expansion phase of that weekly candle if my bias and my key level is correct, all right? Now, I will get into further on how to pick the correct key level, all right? But this, again, just an introductory video. So I hope this was insightful, and I will see you guys in the next one. All right, for the second video in this series, we're going to be talking about bias and high time frame order flow, right? The difference between them, how to properly analyze, and how to make money with it, right? So the number one part of trading is bias, okay? If you're on the wrong side of the market, it doesn't really matter what you do, you're going to end up being wrong, right? So it's why I'm putting this as the first video outside of the introduction is because it is the most important, all right? Entry, stop loss, all that doesn't matter if you're on the wrong side of the market, right? So it's making sure that this is the most important video that you will watch in this series, all right? Now, starting with bias, all right? So bias and order flow are two different things, okay? Bias is directionally where the market is headed, right? So is the market bearish or bullish? That is all biases, all right? Order flow is how the market delivers to that bias, right? What I see a lot of people do is their analysis is correct. They can draw an arrow on a chart and price gets to that arrow, but how price actually gets there, they don't make money with it, right? And that's because your bias and your identification of order flow have to be in alignment, all right? You can't just know where price is going and expect to make money from it, all right? Just because you think price is bearish doesn't mean that every single daily candle is going to print bearishly, right? And that's the difference between understanding how you have to understand order flow and its correlation to bias, and simply not just trading bias just because you're bearish, right? So getting into it a bit, We will begin off with bias and then we'll go into order flow. So bias is basically the study of market profiles. All right. Now, what do I mean by that? Market profiles is how we react at highs and lows and key levels. Okay. So identification of bullish market profile is we are rejecting lows and we are breaking through highs. All right. As an example, rejecting lows, breaking through highs. Rejecting lows here. Okay. Rejecting lows here. Okay. This is bullish market profile. Bearish market profile is when we begin to reject highs and break through lows. Reject highs, break through lows. Okay. This is how you identify market profiling. Okay. Now, an important thing to note is that different time frames have different targets. Different time frames have different market profiles. And this is how we understand bias, understanding the until. Okay. And I'll explain that a bit. Now, if we go to dollar, for example, and we go to a 12-month chart, all right? If I look at market profile currently on a 12-month chart, I see we are breaking lows, or excuse me, we're rejecting lows, and we are breaking through highs. All right? So a reasonable expectation is to expect this to continue until proven wrong. AKA, if we drop below a yearly low, I'm going to expect a continuation of this yearly profile. All right. Now, within this bullish yearly profile, if we go to a monthly chart, what is the monthly market profile? Well, we are rejecting highs and we are breaking through lows. Okay. So it is a reasonable expectation for if we are to pop above a high, a monthly high inside of bearish monthly market profile, that high is rejected to continue lower. Okay. Now within this bearish profile, if we go to a daily chart, a daily chart is in bullish profile, right? We are rejecting lows, we are breaking highs. Okay. So why am I telling you guys this? Well, it's important to understand that different time frames are moving at their own pace, right? Just because a daily chart is bullish or a weekly chart is bullish doesn't mean a monthly chart is bullish, right? Or just because a monthly chart is bearish doesn't mean a yearly chart is bearish, all right? And this is how we create the until, all right? And the first part of understanding this is knowing that the higher time frame always has a larger emphasis on it than the lower time frame. All right. The same reason that if, price is extremely bullish on a daily chart and we're running into a daily fair value gap with an hourly downtrend, that hourly downtrend does not matter and we expect it to reverse inside of that daily gap. Why? Because the daily gap is on a higher time frame. It has more precedence than an hourly would. Okay. So you have to think of that the same way as the daily, weekly, monthly, yearly charts. All right. A daily chart is only short-term bullish or bearish until a higher time frame chart is ready to continue its market profile. All right. So if a weekly chart is bearish, but a daily chart is bullish, that daily chart is only bullish until a weekly chart is to be bearish, or until it's proven wrong. Right. So if I look at current price action right now, a weekly chart to me is bullish. Why? Because we are rejecting lows, we're closing above highs, we're continuously rejecting lows. Okay. A daily chart is also what? Bullish. Rejecting lows, breaking highs, rejecting lows, breaking highs. Okay. So you can expect for market profile to continue until proven wrong. And I'll talk about what happens when you're proven wrong in a minute. Okay. So, but the point is that you can expect a weekly and daily to be bullish until a monthly can be bearish again. The same way that on a monthly chart, you can expect a monthly chart to be bearish until a yearly can be bullish again. All right. A lot of people look at these candles kind of blankly and they say, oh, a daily chart's bullish, so I'm just going to keep longing forever. Right? In reality, that doesn't work. Okay? Because a daily chart can be bullish until a weekly or monthly can be bearish again. Right? Or a weekly monthly can be bullish until a yearly can be bearish again, and vice versa. Right? So the number one thing of bias is understanding what time frames are doing what. What is a specific time frame's objective? Okay, where is it headed? And how can price at certain levels get it to go there? Right? That's what market profiling is. Again, each time frame is moving on its own pace. So in order to understand where price is going currently, you have to ask, where's a monthly going? Where's a weekly going? Where's a daily going? And from that information, you can start to understand, right? If a daily and weekly are bullish, but a monthly is bearish, then you should probably be short-term bullish until a monthly can be bearish again, and then you'd expect some form of reversal, right? And then if a monthly, weekly, and daily all turn bearish, well, then you know you have one-sided delivery and likely a higher time frame expansion, okay? So these are kind of the intricacies of bias that are how you can identify the correct, but also when to expect reversal of the current trend for this high time frame delivery. All right. Now that you kind of understand bias, order flow. Order flow is how we deliver to that bias. All right. And I'm going to use some recent price action to kind of show you guys. So when we are thinking about order flow is all about understanding liquidity pools. Okay. So what I want you guys to think is whenever price rejects a low, for example, here, all that we are doing is we are trying to follow the big funds and big institutions, right? If big funds and big institutions are long, they're going to push price higher. If they're short, they're going to push price lower, right? That's how price moves. Okay, so if we go to a 4-hour chart and think about that, if price rejects a low, here for example, this likely means that big institutions, big funds, that they are buying these stop loss orders here with the idea of them wanting to push price higher. All right, that's how you should view liquidity in these markets. If price is rejecting a low, it's likely that the stop loss orders at that low are being bought to deliver to the opposing end of the range, right? So when these stop loss orders are here, and this is called order pairing, if big funds are pairing these orders or buying up these orders below this low, where's an opposing level that they can seek to sell these orders to? Well, it would be this high, right? Now, what happens if we take out this high and we reject? Well, that means that the orders that those big institutions bought from down here, they covered those orders at this high, right? So they are no longer net long. Smart money is no longer net long from this low after this high is rejected. So in order for them to continue to push price higher, they need to seek more liquidity. They need to re-engineer a position for them to get back in. So where's the liquidity after this low, or excuse me, after this high is rejected? It's these lows, right? When price comes back below these lows, again, it rejects. They're buying these orders, and they're seeking what? Opposing liquidity. What happens at this high? It rejects, right? Where can opposing liquidity be? Well, we have an order block / breaker, and we engineer a low to soup and to expand, right? And then when price delivers through liquidity pools, what does this mean here? This means that smart money, they are still net long from this position, right? If they are pushing price past these opposing liquidity pools, that means that they are pushing for a further target. that they are continuously in their positions and they are looking to propel price higher. Okay, so that's how you should read liquidity. You want to read rejection versus displacement. Rejection of highs and lows means that smart money is likely order pairing, right? They're buying this low and they're offsetting it above this high. They're buying this low, they're offsetting it, right? But when they continue to buy lows and they push price through highs, that's telling you order flow wise that price is likely to continue higher, right? Now, how do we actually use this, right? Well, if I clear this up, even if you are bullish here in all this price action here, all right? And let me start from the beginning. If you are bullish, and there's something that you should always follow with order flow. Order flow, you want to probe and follow until you're proven wrong. So if you believe a daily and weekly market profile are bullish, you should follow and probe that market profile, meaning you should make sure you're on the wrong side of it, and you should be following it until you are proven wrong, until price action shows you that that market profiling is failing, all right? So if a daily and weekly chart is bullish, and we're dropping below lows inside of daily and weekly levels, we want to buy, right? So you could have bought here. Now what happens at this high? It's rejected, all right? But how do we use this in terms of order flow? Well, if this high is being rejected here, that means the next move higher is likely going to seek liquidity first, which would be at this low. Hence the range. Right? And then this is where the difference between order flow and bias comes in. Just because you're bullish, you could have bought continuation moves in here and gotten chopped up, right? Because you don't understand how order flow develops and how order flow moves. But after this, you should have saw, okay, we have a bullish move here. We rejected the high, which means it's likely to seek the low before continuing higher. And then you avoid getting chopped up inside this range. Right? The same way here when we reject this low and it delivers to the high but rejects the high, you see, oh, the rejection of this high is likely to seek these lows before going and continuing higher, which would avoid losses trying to trade continuation in a market that is seeking a discount. Okay? This is the difference of reading order flow versus simply bias. Order flow tells you how price is delivering to your bias, all right? And now to kind of summarize the rules of order flow, all right? Rule number 1, follow and probe, okay? If your high time frame bias is short-term bullish on a daily, weekly, even just on a daily, whatever it is, whatever your bias is, follow and probe that bias. So if we're dropping below lows in a bullish bias into key levels, you expect it to hold until you're proven wrong. All right? That's step number 1. Step number 2 is don't buy high, don't sell low. Right? AKA meaning when price is overextended and we take out liquidity pools and reject it, you have to ask yourself, is smart money still long? Right? Because we want to be on the right side of institutions and banks. Are they still long, or did they offset their position and they have to reaccumulate it below lows? Okay? That should be the thought process. Or if we expand through highs, okay, smart money is still long. I want to look to follow their positions to wherever they are looking to offset it at. All right? That's the identification of order flow. It's more than just I'm bullish, I want to buy. It's I'm bullish, and this is how price action is printing within this bullish structure on how you can frame a setup. Okay? So those are the 2 major rules of order flow. All right? And now I'm going to break this down to you guys on how I have it within my system. Okay? Because I want to teach you guys exactly how I do this. So step number 1 is you have to identify which time frames have what types of market profiles, right? So this is how you understand if the daily bullishness you're expecting is short-term, long-term, if you're unsure, right? the number one step is understanding what time frames are doing what, right? Is a daily chart bullish with maybe a weekly bearish? So then you know a daily can only be short-term bullish until a weekly can be bearish again. Or possibly a daily and a weekly are bullish, but a monthly's bearish. So you're targeting a monthly level in which price can reverse from, all right? That's always step number one, is understanding market profiles, understanding what time frames are moving, how and where, okay? Now, step two, within that market profile is, because that market profile is how you derive your bias. Once you have that bias, it's reading order flow. Okay, how do we read order flow? Well, you follow and probe it, meaning you trust those levels, right? If you trust daily and weekly bullishness, you trust stop runs into those levels until they fail. Okay, and then if they fail, you reanalyze your market profile and you do the exact same thing the other way. All right, but again, step two, follow and probe order flow. All right, if we are dropping below lows into high time frame levels, you trust them, okay? If we are pumping above highs into high time frame levels within the expectation of your bias being bearish, you trust them, all right? And then number three is don't buy high, don't sell low. Again, this is how we understand how to avoid these ranges, how to avoid trading continuations in a bearish retracement, all right? Whenever price hits a target, you always need to wait, okay? I don't know, you don't know, nobody knows when we hit a target if price is going to reject it, if it's going to displace through it, okay? That's what tells us if the banks or if the institutions are still net long or net short. As we see, we look, okay? Is this liquidity pool getting displaced through? If so, the smart money is likely targeting a longer term target to the left, right? If this liquidity pool is getting rejected, well, it's likely that they're offsetting their positions above that high and they need to seek new liquidity pools below price. And then people who don't see that are going to be caught trading continuations in a retracement. Okay? So that's step number three. All right? And I don't like to overcomplicate things. I like to keep it simple and easy. Right? The more you overcomplicate a system, the harder it is to be consistent with it. Okay? The easiest way to trade, in my opinion, is to keep your thought process simple, clear, and precise. All right? You don't want a ton of moving parts, because then when it comes to actually performing it week in and week out, it's going to be very difficult to do, because you're thinking of, oh, this could happen, right? Keep it simple. Bias, understand bias from market profiles. Once you have that bias, understand how price is going to deliver to that bias with an order flow. Okay? Use the teachings from this. Backtest it if you want. Again, I like to teach in more recent action, because anyone can go to a perfect chart and find the perfect weekly candle and say, this is exactly how every candle is going to print. It's not. Okay? There's going to be good weeks. There's going to be weeks that are a little bit choppy. There's going to be bad weeks. Okay, that's just the reality of it. So think like this, and this is how you avoid these ranges. Okay, within this price action here, I took this long. I closed it at this high because we were rejecting. I took this long. I closed it at this high because we were rejecting. I took this long. I closed it early because of overseas news. I didn't want to hold that position in case something over the weekend happened, which is all right. Okay, I took this long up to here. Okay, I'm teaching you guys these things because this is what I do every week, right? But again, and I really want to preface this, bias and order flow are different. Just because you're bullish doesn't mean every single day is going to print bullishly. Doesn't mean because that 4-hour order block you're marking is going to work. Okay, that's not how bias and order flow work. You have to have them in combination with each other to actually be able to trade a bias consistently, and not just mark an arrow on a chart and it goes there, but you made no money. Okay, so that is all for this video. I hope it was insightful, and I will see you guys in the next one. All right, welcome everybody. For this video, I'm going to be talking about picking the correct key levels. Okay, so this is a very important topic that I get a lot of questions on personally. How to pick the correct key level. All right, and I'm going to kind of break that down how I do it today. All right, so one of the main ways of picking the correct key level is understanding that smart money moves on the high time frames. Okay, these banks, these institutions, all of the big players in the market, they're not trading hourly charts. They're not trading 15-minute charts. They're not trading 5-minute charts. They are positioning themselves on daily, weekly, monthly, quarterly, yearly, right? The higher time frame charts, that is where they're looking to position themselves, okay? So as being traders, and we want to be following what they're doing so we can catch the trends that they originate, we should be doing the exact same thing, all right? So what you should be focused on doing is looking at daily charts and above. All right, 80 to 90% of your chart time, you should be on a daily or above chart. Why is that? Well, because a daily and above chart gives us two things. Number one, it gives us direction and context to setups, right? So why is price going to this? And then number two, we can identify where are these price legs going to originate from, right? So if I'm bearish, I'm looking for daily, weekly, monthly key levels to take me to my bearish target, right? And in my experience, I've been trading for 5 years now. My bread and butter model and my bread and butter setups are always daily plus key levels, all right? They give the best reactions. They are the most consistent, okay? So that is what you should put your focus on, all right? Now, how to actually do this correctly, okay? And we can take these past few weeks, for example. If we look back to the first introductory video, everything starts with that. Everything starts with direction, and then where's the wick going to form towards that direction, right? This is how we identify where is that wick going to form, all right? So if you have a preconceived idea that we are likely to be bearish, what you want to do is you always want to start from a higher time frame. Because again, I want you guys to imprint into your brain the higher time frames are much more important than the lower time frames, all right? If I wanted to short inside of this candle, I'd ask myself, is there any monthly key levels? Not really. I go to a weekly chart. Is there any weekly key levels? Yes. Where's the weekly key levels in here? Well, if I'm looking to trade this week, okay, May 25th, what do we have? We have a gap, and we have an order block. Why is this an order block? It purged a high. Okay, I go to a daily chart. What does a daily chart have? We have a gap overlapping with this key level, okay? And then we go down to an hourly, which is our intra-week entry, and how we identify a weekly candle, all right? And we can see we stabbed into these key levels, they rejected, and we expanded, all right? So understanding why is it that we're picking these key levels? Because the higher time frame is what controls these markets, right? Let's say that you didn't take this and you waited for this next week, right? Which would be start here and end here, all right? Well, what high time frame key levels from this week could we have traded? Well, we created an order block, right? So Monday opened, delivered lower, and created an order block. And then look what this week tapped before delivering lower. Was the order block, right? And if we go to a lower time frame here, this is an hourly turtle soup, 8 o'clock on Tuesday, all right? The same thing if we go back into price. Let's say you were bullish here off of current market profile. Right? When we drop into a weekly gap, again, using high time frame key levels, top-down approach, this weekly gap is also what? coinciding with a breaker, or a weekly order block, daily breaker, we can see here, what do we get? We get a soup. Okay. The same way that this next week, if we mark the rejection block and we go to an hourly chart, what do we see? We see a low being put in, we see a range, a stab into this low inside London session, and an expansion. Okay. Now I'm showing you guys these for two reasons. Number one, these are trades that I took, and number two, repetition. Okay. The more and more that you see these high time frame key levels creating these expansions like this, the more and more you're going to be able to trust it. All right. Now, because price has different phases, in different phases of price, I will trade different types of key levels. And let me explain that for a second. So the market always moves, where is it? Here it is. In ranges, to expansions, to ranges, to expansions. Okay. This is how the market moves. All right. Now, whenever the market is in a higher time frame range, I'm always requiring a daily or higher key level for this manipulation to form an expansion in. All right, so let's say, here, for example, we're in a higher time frame range. For me to trade the next higher time frame expansion, or for me to even expect for price to start expanding, I need a new higher time frame level to sponsor that move. In this case, it was the weekly gap. All right. Same with here. We hit a target. We start ranging. Okay. For me to expect this next week to deliver higher again, I need a daily level or higher to sponsor that move, which again, we got right here. All right. Now, this is not the only ways to pick key levels. Okay. I pick daily plus key levels when price is ranging and I need a manipulation, right? So if we haven't put in a manipulation for the week, for the month, I am seeking these higher time frame key levels to form that sponsorship so that the higher time frame can be in alignment and that it can expand, all right? But that doesn't mean you always have to trade this, because if we go back to this up here, in the manipulation phase of price, you always want to seek these higher time frame levels. In the expansionary phase of price, you can start seeking lower time frame levels. And I'll show you why. If you go to a 4-hour chart here, and you go to just a random key level in the middle of nowhere, this gap, there's no confluence to why this gap should hold. And if you trade it, you're trading it as a pattern. And to be consistent, you have to be avoiding patterns. Okay? The same way that if you were to trade, I don't know, literally any random key level, this gap. Okay? If you're just trading these key levels at random, then the likelihood of them working out and the consistency behind them is going to be random as well. Right? Your equity curve is going to show that you're trading randomly. Okay? But look at the confluence and context here. If I'm bullish on a weekly and daily chart, I know that for the next higher time frame expansion, like I showed you guys, you have to understand that it has to be sponsored by a higher time frame key level. Okay? In this instance, we have a weekly gap. Now, when these swing points form, we expect these to hold, right? In a weekly bullish market profile, a stop run inside of a weekly gap we expect to hold. Now, when these weekly swing points form, the key levels created off of these swing points have confluence to why they should hold, right? If I expect this low to hold and this low creates a 4-hour order block, well, that 4-hour order block should hold, right? Or if this low creates a 4-hour breaker, that 4-hour breaker should hold, okay? This is how we trade continuation entries, all right? So let me mark out this weekly candle. All right, so this is this weekly candle on a 4-hour chart, open to close. When we know that the manipulation of the week has been put in, sponsored by a higher time from key level, on Thursday, we know that the key levels that this creates should hold until a target is met. Meaning, when this low creates a 4-hour order block, this 4-hour order block is now high probability because it was created off of a weekly gap. Notice the difference here versus the difference of picking a random 4-hour order block in here, right? Or a random 4-hour level in here. There's a big difference between that and looking at it through this lens. The same way that when this expansion here creates a 4-hour gap coinciding with a breaker, that it makes sense why this should hold rather than, again, randomly picking any random key level you see on a chart. Okay? There's context to this because this expansion here has been sponsored by a weekly level. Therefore, the 4-hour levels or hourly levels that this weekly level creates have context to them holding. Okay? The same way that if we seek entries in this next week following the same idea, until a target is met, of course. When we get this turtle soup inside of that daily rejection block, and this daily rejection block creates a 4-hour order block, again, this 4-hour order block has context to it. It's not just a random order block you're marking on a chart and wondering why it doesn't work. This order block was created off of a daily level. That daily level had a stop run inside of it. Okay? This is how that we can understand what key levels should we actually be taking and stop pattern trading, random order blocks or random fair value gaps. Okay? Everything that you do should be high time frame down, top down. Okay? Whenever you're looking at analysis, start on the highest time frame and work your way down. Whenever you're looking at key levels, start on the highest time frame, work your way down. Right? And when you're looking to actually enter inside of these levels, think of this. Think of what phase of price are we in. If we have put in a manipulation inside of a high time frame level, then you can seek key levels that this creates. If we met a target and we start ranging, well, then your next level or your next setup should be forming inside of a daily, weekly, monthly key level, right? Maybe you missed that. Maybe you missed the daily, weekly level that creates the next expansion. Well, then if this creates a 4-hour level, that 4-hour level is now high probability, right? This is how price moves. Ranges, manipulations, expansions. Understanding which phase of price you are in is how you can understand which key levels you should be even looking to trade, right? If price is in a range, and I know since we took out this high, I shouldn't seek any more levels until a daily or weekly or monthly. That's when people pattern trade these gaps and they get wrecked. Or pattern trade these order blocks and they get wrecked, right? That is why it is so important to understand, number one, order flow, and number two, how to trade that order flow, right? Which levels are you looking at? When do you look at 4-hour levels? When do you look at daily, weekly, monthly, right? It's all under the umbrella of this. It's all under the idea of ranging, manipulating, expanding. Ranging, manipulating, expanding, right? This is all price ever does. When do we range? Well, when a target's met or when time comes to an end, right? What do I mean? If a target is met and it's rejected, we know to wait and seek for a new level. If the end of a candle, let's say low of week, is on a Tuesday, and on a Thursday we start pulling back into the range, okay, well, a new range could form. Why? Because candles print open, high, low, close. Here's a range, right? This is how you understand which levels it is to trade. All you have to ask yourself, which phase of price are we in? Are we in a phase where a range is likely to form in which I need a new manipulation level? Or are you looking to trade a continuation of a manipulation level in the expansion phase? And then that's when you can seek these lower time frame levels on a 4-hour, hourly, okay? That's how you understand which levels to pick, okay? And when you combine this idea here within the introductory video where you're looking to trade a weekly candle, the weekly candle should be sponsored here, right? If I just turn this into a weekly candle like this, and this weekly candle then gets turned into daily candles, which days of the week do you think you should trade here? Probably Wednesday and Thursday. Avoid the range, right? So all these things all these things work together in unison, right? And it's important to understand this because I think a lot of people where they get it wrong is they trade key levels as a pattern and not as a logic, right? Just because there's a fair value gap or order block doesn't mean it's going to hold, right? But when there's an order block sponsored off of a weekly gap and weekly bullish market profile on a Wednesday after a Tuesday low week, there's context there, there's logic there, right? Consistent trading is based off of a logic, not patterns, right? Patterns will not get you very far. The pattern is used once the logic is identified, all right? So it's something to note when you're looking to understand where to actually position yourselves in these markets and where not to position yourselves in these markets, okay? Now, that is all for today's video. I hope this can kind of help clear up a little bit about key levels, and I will catch you guys in the next one. All right, so in today's video, I'm going to be covering over entries and stop loss placement. All right, so let's get right into it. So starting off with entries. Now, it is important to note that the reasoning behind why I put analysis before the actual execution in this series of videos is because execution is a pattern, and a pattern is only to be looked at after the logic has been formed, right? A lot of people look at entry models as the reason to get into a setup, right? Entry models should only be looked at after the analysis has been put in, right? There has to be criteria in which when you start to look for entries, not simply just looking at them as a pattern, okay? So I wanted to start off with that because it is the most important part of trading is why you're looking to enter somewhere, not the actual pattern of the entry itself, all right? Now, when we actually get down to the entry models, there's 3 different entry models that I will personally take, okay? Number 1 is simply turtle soup. This is my bread and butter. This is what I look for in every single trade that I take. 95% of the trades that I take are going to be this, okay? Now, another entry model I have is my confirmation entry, okay? Now, I personally prefer to take turtle soup, but if I do miss the turtle soup, I will look to find some form of confirmation entry, which I'll explain in a bit, right? Now, if I miss both of these, the third one is going to be the OTE, which, again, I will go through these one by one, explain them with a few trades that we've had in the past couple weeks, and let's get right into it. So if we look at, let's say this week, for example, we were short-term bullish. We delivered out of a weekly gap. We had a daily rejection block here, and we also had a 4-hour breaker here, okay? So this is 3 setups. We have a soup inside the weekly gap. We have a soup inside the 4-hour breaker. And we have a soup inside the daily rejection block, okay? Now, and let me bring this down here a little bit. So one of the reasons why I prefer turtle soup over every other entry model is because turtle soup is very black and white. Let's say you have a key level, for example, and price goes into your key level, it goes lower, you enter, it soups again, and then drops. and then your idea was correct, but you still took a loss. Okay? This is what I do not like. When my idea is correct, I like to have a winning trade idea. I don't like to be correct in my analysis and still be taking losses. Turtle Soup voids this completely, because instead of trading the reaction out of a key level, you're trading the key level itself. So if I expect a soup inside of this level, then I would look at this level and say, okay, at what point in price, if it is hit, does this level now being invalidated, right? So for example, if this price point was hit, I would say that this key level is not holding and the idea is incorrect. Okay, that is why Turtle Soup is my preferred entry, because it's very black and white. You're either right or you're wrong. And with anything other than Turtle Soup, you can often get caught up in the lower time frame reactions. And if price action is unfavorable and it's not quick and easy, which of course we want it to be, but it's not always like that, then you can get caught up in those lower time frame consolidations, those resoups, or even possibly when we just take out a high and give 0 entries, right? So Turtle Soup kind of voids all that. You're simply, instead of trading a reaction out of the key level you're watching, you're trading the key level itself. You're trading the stop run inside of the key level itself, right? So if we look at this on these 3 entries down here, we have 1, drop below a low, 2, drop below a low, 3, drop below a low. Now, what do I look for when I'm taking Turtle Soup? So a lot of people look for these lower time frame patterns of we close below the low, we soup with the next 15-minute, or we have a double soup below the low, all this stuff, okay? If you want to keep your trading extremely simple and consistent, all you need to think about, if I cleared these charts, there are stops below this low here. There are stops below this low here. There's stops below this low here. Whenever price purges these stops, so when orders flow into the market, when this low is being taken out, you want to buy those orders. I'm not looking at a pattern of some lower time frame BS. I'm not looking at anything outside of stops are being ran, and I want to be the counterparty to these positions that are flooding into the market, right? So when these stops are engaged, I'm buying below the low. Again, I'm not looking at a pattern. I'm simply buying. Same thing here. I'm not looking at a pattern. I'm buying, right? A lot of people try to get too perfect with their entry when let the trend make your money. You don't need to have the tiniest stop loss, the most precision entry. All you need to do is catch trends consistently, right? And Turtle Soup allows for high RR in doing so, okay? A lot of people try to overanalyze execution and they end up underanalyzing analysis, right? All you need to be is on the right side of the trend and frame high probability setups with high RR. That's it, right? So for this first entry, I do not look at a pattern whatsoever. And again, I am 95% of the time, I'm looking to trade this. I'm looking to trade a stop run inside a level, enter, stop run inside a level, enter, stop run inside a level, enter. Nothing on the lower time frames here, okay? Now, if we mark all the levels, so we had the weekly gap, we had the 4-hour breaker, and then we had the daily rejection block. And these are all setups I have traded personally. If I am to miss the Turtle Soup, I look for a confirmation entry. Now, what is a confirmation entry? Okay, a confirmation entry is a shift in order flow off of the level you're looking to hold. Now, again, I don't look at patterns, I look at context. Okay, so how can we infer that order flow is shifting? Well, there's 2 different ways. Number 1 is a shift in market profile. So if we take out a low and we start shifting through a high, that means retracements are for buying. Retracement into what? Into any key level or below any low, right? After order flow switches from a price level that you expect to be a longer term swing point, after we shift through a high, which is a shift in market profile, retracements are for buying. Same thing over here. We take out this low, we shift through a high, retracements are for buying. You can see the same thing on this one. We take out a low, we shift through a high, retracements are for buying. And again, what do you buy? Now, me personally, I prefer breakers, order blocks, and gaps. Okay, and I prefer to view this on a 15-minute chart. Now, if you're more of an intraday trader, you can go to a 5-minute. If you're more of a scalper, you can go to a 1-minute. For me, in my system, I prefer a 15-minute, but that doesn't mean you can't use other time frames. Okay, but again, this is number one. This is the first confirmation of a shift in order flow. The second confirmation is PDA shifting. So what does this mean? This means when, let's say, and let me draw a little chart over here. Let's say the high we have to shift through is up here, and we're all the way down here. Okay, if you let it shift through this high, you've already missed basically the move. So another way that we can probe order flow and find early indications of it shifting is when bearish levels are getting disrespected at the same time bullish levels are getting created. Right, so let's say we have a bearish gap here, but we're creating a 15-minute order block, and we shift through this gap. This is an indication of order flow switching, in which before we shift this high, you can anticipate the low being in. Right, now notice, I'm not using patterns of we create a low, we create an order block, or we create a low, we create a gap. I'm using the context of order flow switching off of a predetermined level we expect to hold. And again, what is order flow switching? Well, we can see it here. We disrespect a bearish 15-minute gap, and we create an order block, right? Or we go over here. This one, we shifted a high before we disrespected any bearish PD array. So you would use this as your confirmation of an order flow switch. If we go to this one, same thing here. We shifted a high, so this would be your confirmation of order flow switch. All right. Now, if I go to another setup that I took that was based off of this exact same logic, was here. Okay. Now, I missed the turtle soup on here. So what is my next entry? My next entry is a confirmation entry on a 15-minute chart, which is what? It's either the shift in order flow below a low or the shift in PD arrays. Now, if we look at this chart, for example, we took out this high and we had a soup of these lows. A soup of these lows would mean that this price action in here should be a breaker. Okay, is this breaker holding on this delivery lower? No. And at the same time that this bullish PD array is getting disrespected here, we are creating a bearish 15-minute gap. Okay, that was the means for entry inside of this gap, was the idea that order flow is switching off of a high I already predetermined from the higher time frame analysis should reject and hold the target. Okay, so that's the context behind it. Again, a lot of people look at entry models as patterns. They look at order blocks off of highs. They look at gaps off of highs. What you want to do is you want to add logic to the pattern. Why should you trade this order block? Why should you wait for this order block and maybe wait for a gap or wait for the next order block, right? That context comes from viewing, instead of viewing PD arrays as patterns, view them as order flow, right? Instead of viewing, let's say, an order block off of a turtle soup, ask yourself, did this order block invalidate previous order flow? And if not, then you should probably wait. And if it did, then take it, right? So the confirmation entry is all about, you miss the actual soup itself, you wait for a shift in order flow, again, either through a lower high or through PD arrays switching, and then you take an entry. Any retracement, right? You seek for an entry, okay? Now, the third and final entry that I will take is the OTE, okay? Now, an OTE entry is, let's say you're looking to trade a daily candle. That daily candle creates lower high of day. And let's just say, for example, that lower high of day is created in London, okay? When London, again, you missed the soup, you missed the confirmation entry, okay? When London is a low that we expect to hold, right? So a longer term low that we expect to hold. And London creates a key level off of it, let's say a 4-hour, hourly, whatever it is. We expect key levels off of protected lows to hold towards our high time frame analysis, okay? So an OTE entry is simply a turtle soup inside of a key level that was created off of the lower high of day, right? So let's say, in another example, if this is Asia, we see Asia has a protected soup, we expand off of it, Asia creates a 4-hour order block. If London is running into this 4-hour order block below a low, that gives a valid OTE entry. And again, an OTE entry is basically you miss the wick of the candle, and during this expansion period, a retracement back down into this, into the key levels created here before we start expanding higher. This is all an OTE entry is. Okay, so whether this is London and this OTE is in New York, whether this is in Asia, this OTE is in London, whether this is in New York, this OTE is PM session or next day Asia, okay, that's how you want to view the OTE entry, is you miss the actual lower high. That lower high creates an hourly or 4-hour key level, and then you trade that 4-hour key level as a continuation of the current lower high, okay? That's the idea behind it. Now that we've gone through, and I guess I can show an example of this as well. With this weekly gap here, this weekly gap creates what? It creates an hourly breaker off of it. This hourly breaker here has a drop below a low inside of it. Here's your OTE entry. We get the low in London, we expand, we retrace in New York, 9 o'clock, below a low, inside a key level that London created. And again, why is this key level high probability? Because we trust this low to hold until the target is met based on our high time frame analysis. So expansion, retracement, expansion, okay? If we look at the entry over here, here it is. We see we have a turtle soup. We expand, we created a, I believe it was a 4-hour order block here. We have a drop below a low inside of Asia, expansion. Here's your OTE. All right. Now, when it comes to stop loss placement, now that we've gone through the entries a bit, so stop loss placement is different per the entry model that you use, right? So again, for me personally, I prefer turtle soup. It's a very black and white way of trading the charts. I don't lose when my idea is correct, and that's my main priority. I'd rather focus on the high time frame positioning than the lower time frame action, right? Lower time frame action can be very trappy and tricky at times, and turtle soup completely voids that, right? So when you're trading turtle soup, there's a few different ways that you can use stop loss placements. Number one, and I'm just going to use this line as a key level example, right? So if this is your key level, and let's say you're trading a turtle soup into this level, okay? There's really 3 different ways that I look and view stop losses. So number one is I'm always looking, is there a intermediate term high or low to the left that I can use? Now, why do intermediate term highs and lows work? Because let's say I have a high, an intermediate term high here that we expand lower from, okay? If this high is to be hit, that means the range that I'm trading is getting expanded through. So this intermediate term high is now a liquidity target past the range that I'm trading. AKA meaning my range is no longer a turtle soup. If the range that you're trading is seeking further liquidity outside of the range, then you're likely not in a turtle soup, and your key level likely is not holding, in which a invalidation point would be a good place to get out of that setup, right? And same thing for the flip side. If you are wanting to long a low here, and there is a low nested below the level, if this range is seeking further liquidity, then it's likely that the range is not a turtle soup, because it's still seeking and extending towards downside liquidity pools past your level and past your range, right? Again, meaning that you likely want to get out of that position because it is not a turtle soup, okay? Now, if there is no intermediate term high or low, I look for lower time frame key levels. So let's say I'm trading a daily order block here, and inside of this daily order block, there is an hourly gap. Well, an early indication of this daily order block failing would be the hourly gap inside of the daily order block being closed through. So a stop loss level would be trusting the lower time frame levels that coincide with your higher time frame level, right? When I traded this rejection block here on Euro, if I can find it, here it is. When I traded this rejection block here, and I go to an hourly chart, I had this breaker, right? So what was lined up with my level? It was this breaker, and I had an intermediate term low below this turtle soup here. So this was my stop loss for this setup, right? Now, if there wasn't an intermediate term low here, I would seek some form of key level to protect my stop loss inside of my higher time frame level, all right? Again, with the example above. If there is no intermediate term high or low, you want to look for lower time frame levels inside of your higher time frame level that can protect it, right? So you can go through a 4, go through an hourly, even to a 15-minute if there's nothing. And look, like maybe there's an hourly gap. Maybe there's a breaker that can protect your stop loss and you can put it above, right? All these lower time frame levels are early indications of the key level you're trading is likely to fail if they are to be broken. So it's a good place to put your stop loss as an invalidation point for that setup. Okay. Now the third, and I try not to do this one, but it is sometimes necessary, is a static stop loss. Now a static stop loss is when there is nothing to the left of you, right? So let's say you're taking a higher time frame reversal. There's nothing really to the left of you to use, okay? And all you're really trading is a turtle soup inside of a key level, okay? There's no lower time frame level. There's no intermediate term high or low. Then I will just use a static stop loss. Now, a static stop loss can be different from time to time. Sometimes you can use 10 pip, 15 pip, 20 pip. If you want to be more conservative, 25, 30. It all depends, right? The volatility in the market is always changing. There's some times where a 30 pip stop loss is huge, and there's some times where a 30 pip stop loss isn't that big, right? So there's a volatility discretion when it comes to static stop losses, where you kind of have to test out what works best for you, okay? But if there's nothing to the left of me, I will simply use a static pip amount and sell the high or buy the low. And the reason of that is I'm basically trading the idea that the key level should hold and that this high here should be broken out of falsely. So if this high starts getting displaced through and my stop loss is hit, well, it's likely that this isn't a turtle soup and I want to be out of the trade, right? And that's why, again, I prefer turtle soup. Is when your stop loss gets hit, you're wrong. There's no, oh, I could maybe re-enter here. No, your key level isn't holding, your range isn't rejecting, You're simply wrong. Go to the next idea. Okay. When you trade reactionary entries, you oftentimes can get stopped. Maybe it soups again, it starts going lower, and you can want to enter again, right? And then one wrong idea can turn into 2 losses or 3 losses, right? When you strictly trade turtle soup, or at least majority of the time trade turtle soup, it's very black and white. My stop loss is hit, I'm wrong. On to the next idea, okay? And that helps risk management a lot, and emotional control when you know that it's just one and done every setup. One shot, either works or it doesn't, on to the next, okay? Now, when we go to, or I guess finishing off of turtle soup, if we go to the confirmation entries, right? So the 15-minute, or if you're more intraday, you can use 5 or 1. So basically after you see that 15-minute shift in order flow for the confirmation entries, let's say, for example, here, you see the shift in order flow, you see we create a order block, you enter inside the order block. All right. There is a few different ways that you can use stop loss placements for confirmation entries. Number one, and probably the best, is you put your stop loss at the protected low. So if you're trading a reaction, you trust the low that is the low that we created the change in order flow, right? So again, whether your retracement is to an order block, retracement is into a gap, retracement is to in a breaker, whatever it is, you trust the low that created the shift in order flow, okay? That's number one. Number two is you can trust key levels created off of the low, right? So let's say you didn't get this early reaction or shift in order flow here, but you saw this shift in order flow and you took this retracement into this gap, okay? Well, a stop loss could be possibly below the breaker, right? Why? Because a lower time from key level should protect your stop loss from being hit in a bullish market, okay? The same way if we look, let's say to this setup, if you waited for a shift of this high here and then took a retracement, you can see the order block should protect your entry, or excuse me, your stop loss, and you can put it below, at the low, right? So the two different stop loss placements I would use in reaction entries is either the very low or high, or a key level created off the lower high, right? And again, it all depends on how willing you are to be conservative or how risky you want to be with how tight it is. Again, that's up to the individual and based off of how you trade. If you scalp, intraday, swing, it'll be dependent per person, right? And then for OT entries, it is the exact same thing as turtle soup, right? You have your high time from level, you have your soup. Is there any lows to the left or any key levels to the left? Well, we have a low here. If that's too wide for you, we also have a gap coinciding. Put it below the gap here, right? There's plenty of options you can use, and it's all discretionary based off of how conservative or how risky, if you will, you want your stop loss placement to be, all right? But those are the entry models that I use, the stop loss techniques that I use, and that is all for today's video. So I hope this was insightful, and I will catch you guys in the next one. All right. Welcome to the final video of the series. Today, I would just want to be covering how to put everything together. So I've taught you analysis. So I've taught you kind of what to focus on for the setups, how to identify bias and order flow, how to actually enter on that bias and order flow. Now is putting everything together into one structured system. Okay. So I'm going to be using some of the information in the past videos and connecting them together. And giving you guys a full step-by-step guide on how to actually trade the system, okay? So number one is you need to identify what type of trader you are. Do you want to trade a weekly candle? Do you want to trade a monthly candle? Do you want to trade a daily candle, maybe a 4-hour candle, okay? It's all dependent on the type of trader you want to be. If you're more shorter term trading, if you're more longer term trading, if you're very longer term trading, okay, that is dependent on the trader. Now, me personally, I am a weekly range / monthly range trader. I like to focus on the weekly candle, and I like to identify days of the week that are a high probability to catch that weekly candle. Okay. Now, if you're a shorter term trader, you could maybe focus on the weekly candle and do the same, focus on the daily candles that are high probability inside of that weekly candle. But you want to focus on simply the daily ranges inside of the weekly candle that are likely to be expansive and one-sided, right? So it's two ways of looking at the same thing, right? The only difference is the hold time, right? But again, every trade that you take should be focused on catching the easy trends of the higher time frame candle you're within, right? Whether you're scalping 9 a.m. on NASDAQ, the expansive candles of the week are going to make that bias one-sided and that delivery easy, versus you're trading a range on a Monday or on a Friday and you're unsure of direction, it's very choppy, right? So understanding your high time frame can give you, regardless of what type of trader you are, can give you an edge on the lower time frame. Okay? So step number one is going to be understanding what type of trader you are. All right? Now, step number two is going to be identifying, because again, what you want to be doing is you want to know where price is going and how is it going to get there. That comes before even thinking of a setup, thinking of anything, right? So, for example, I am primarily a Euro USD trader. I trade Forex, I swing trade, I focus on the weekly candle, okay? So for me, what I am doing is I am identifying directional bias on Euro. Okay, now how do I do that? Well, you always start with market profiles. So on a monthly chart, we are bullish. Therefore, when we drop below monthly lows inside quarterly gaps, I expect price to continue higher. Okay, so on a monthly perspective, I'm bullish. On a weekly perspective, price has continuously been rejecting highs, breaking lows. Oops. So on a weekly perspective, we are bearish. Now on a daily perspective, we have also been bearish, holding bearish key levels. Okay, so if a weekly, a daily are both bearish and a monthly is bullish, that gives me bias. How does that give me bias? That tells me that a weekly and daily chart are going to be short-term bearish until a monthly level is reached, right? Therefore, I know that I can seek sells within these daily, weekly key levels, targeting until I can expect a monthly reversal to continue higher, right? Now, does that mean that that's going to happen for sure? No. What I do is I follow and probe order flow. Let's say I long inside of this monthly level and it fails. Well, that tells me that monthly order flow could be switching, and then I follow daily, weekly, monthly order flow until a reversal forms. Okay? So it's all about identifying current market profiles to deliver you a bias. Okay? Now, when you're trading that bias, okay, because once we've delivered a bias, for example, mine currently is lower. Once we've derived that bias from market profiles, the second step is order flow. Okay? Just because we have a bias doesn't mean that we can trade every single day towards that bias. Okay? So a directional bias, and then we have to follow the rules of order flow, which are what? Which is probe and follow order flow until proven wrong. Meaning if I'm bearish, I want to seek stop runs inside of bearish high time from key levels until I'm proven wrong, right? If you short this gap and it fails, that then tells you, okay, a daily can be short-term bullish until a weekly could be bearish again, in which you could seek the exact same setup on the flip side to something like this, right? So step one of order flow is always probe and follow. Always probe and follow order flow. If you are bearish, trust bearish high time frame levels and stop runs inside of them until you are proven wrong, right? Now, step number 2 is don't sell low, don't buy high, right? So when we reject a low in the marketplace, for example, here, it is going to seek liquidity above. This is when range is formed. This is when retracements form, right? You see here, we rejected a low, retracement. We see here, we rejected a low, retracement. Okay, this is when we seek to expect retracements or ranges to form, so we're not continuously following order flow inside of these ranges and these retracements. Okay, now those are the 2 rules of order flow, right? So directionally, you know where we're going. You follow that direction inside of high time frame levels and stop runs, and you follow the rules of order flow, which is don't sell low, don't buy high. Okay, once you've derived all that, all right, and we're going to use, let's just use a random week. Let's go over here. Let's do this. Okay, so what I personally do is I always mark out the candle that I'm trading. So Monday to Monday. Now, if I'm going to trade this candle here, and I do what we did over here. Step number 1 is identify market profiles. Well, on a weekly chart, or excuse me, a monthly chart, we are bullish, okay? Now, because I have seen this before, dollar SMT'd this low, meaning a monthly chart market profile is bullish. A weekly chart market profile is bullish. And a daily chart market profile is bullish. So what does that mean? That means bias-wise, we are bullish. So we are going to target opposing liquidity pools. Okay? Now, because of that, what does order flow say? Order flow says we just took out a high and rejected. Which means what? Which means we need to seek liquidity below and inside of a key level. Okay? So if we have that idea now, so we're following the rules of order flow, which is don't buy high. We derived our bias we derived our bias from market profiles, meaning we are likely to deliver higher. Now it just comes from framing the actual weekly candle that we want to trade. Okay, so if I want to trade a weekly candle, how do I trade it? Well, I need to see when the manipulation is likely to form and trade at the manipulation or after the manipulation. Okay, so where does manipulation form? Manipulation forms inside of high time frame key levels. So if I do a top-down approach from this current week that we're going to be opening up, the wick of this next weekly candle is possible to form inside of this weekly order block. I'd go to a daily chart. Do we have any daily key levels? Not really, nothing really over here, just an expansion higher. So I'd primarily be looking at this weekly order block to form low of week. Okay. Now if we go to an hourly chart and we go to this week and we break this week up into the days of the week to trade, we can see here. Now what would be a good day to stay out on? Monday. Why? Because it is a range. It is the first tap inside of the level. What would be a good day to want to enter? Tuesday. What would also be a good day to want to enter? Wednesday. Possibly SMT here. Would also be a good day to enter Thursday. Okay, until the target is met, in which we start ranging again. All right, this is the idea behind it, is you are identifying direction through market profiles. You're identifying the rules of order flow and trading that direction, and you're looking to trade the manipulation, so the wick and after the wick of the higher time frame candles, so that you can catch the expansions on the higher time frame. Okay, so within this weekly candle here, you could seek entries Tuesday, Wednesday, Thursday. We hit the target, expect a range. Okay, and that's exactly what we're seeing here. All right, if you look into these a little bit deeper, We have a turtle soup inside of 10 o'clock, New York session. We have a likely SMT inside of what? 8 o'clock, New York session. We have a turtle soup inside of 1 a.m. London session. And expansions on each day. Okay, so this is how we break down the high time frame down to the low time frame to find entries. Okay, utilizing all the things that I showed you. And of course, entry model wise, you can take the soup, you can take a confirmation, soup, confirmation. There's an OTE here, there's an OTE here. Okay, it's all dependent on what entry is your favorite and what you prefer to do. Okay, but this is the idea behind it, is we are looking and we are following the high time frame. If the high time frame is destined to deliver higher, we want to be trading higher. Okay? All we're doing is we're just following the big money in the markets. Okay? If they're going to push price higher, all we want to do is catch a ride. Right? And how we do that is we find stop runs inside of these key levels, and we frame it within these higher time frame candles. And in doing so, following the rules of order flow and trading towards our high time frame bias, we can consistently find high RR, high probability entries towards our high time frame targets. Okay? So that is kind of the idea behind it. I can show another example before we close off here. If I go to a daily chart, and let's go to a random week. Let me do this, and we'll go here. Okay, if we do the exact same thing, what is monthly market profile? Bullish. Okay, what is weekly market profile? Bullish. Why? Rejecting lows. Okay, rejecting lows, breaking highs. Okay, so a weekly is also bullish. What is a daily? A daily is also bullish. Okay, so we have weekly, monthly, daily bullish, meaning we should be seeking bullishness. All right. Now that we've derived direction, we have to derive rules of order flow, rules of engagement. We just took out a high and rejected, meaning likely a retracement. Where can we seek a retracement to? Well, we have a gap here. We have an order block here. Okay, so there's two key levels that could now form on the higher time frame a directional movement back to this high. Okay, if we mark out our weekly candle from Monday to Monday and we let it play out, we get a nice range soup expansion. And if I go to this on an hourly chart, which is how we break down and we identify our setups, and I mark the days of the week, okay, so we take out a high, we reject, we wait. Now notice, these 2 days end up being the range, in this day as well, the range of the weekly candle, okay? Notice, gap, we put in a low, we purge at 8 o'clock, we expand higher. When we initially trade down to this level here, it is not holding. An Asia session pushes through it, which means we're likely to want to wait for the order block. It looks like news was on Thursday as well, 8:30. We create a range, we soup, expansion, range, soup, expansion, okay? And we're identifying that the highest probability days to trade of this weekly candle was Thursday and Friday. And if you were to hold over the weekend, you caught a nice expansion to this target and to this target before having a false break at a high and then continuously doing the exact same thing on the downside. Okay? But this is basically how you want to structure your setups. Is high time frame first. Where are we going? That's always step number one, is where is price headed If you don't understand where price is headed, you have no reason to be speculating on key levels, on entries, none of that. You have to understand, where is price going? Number 2, follow the rules of engagement. Just because you're bullish does not mean that you can keep buying above highs, right? Probe and follow order flow. If we are dropping into a daily, weekly level in a bullish market below a low, buy. It is a buy opportunity until proven otherwise, right? If daily order flow fails and weekly order flow fails, then they can be short-term, bearish or bullish, depending on what failed, until the higher time frames can switch it again, right? It's all just a game of multi-time frame market profiling. That's all biases. That's all order flow is, okay? Once you've established those rules of the higher time frame, all you're looking to do is seek stop runs inside of high time frame levels and validate which days of the week are likely to provide the wick and the expansion of the candle that you're trading. Again, regardless if you're a swing trader, an intraday trader, a scalper, you want to catch the easy trends. You don't want to catch the consolidations. That's when all the losses form, right? You want to catch the easy trends. So if that's your goal to do so, you have to validate which days of the week are actually likely to give you those high probability entries, and the entries that where you enter and it just goes, okay? Not trading every single day, you cannot get to that level of analysis because you're trading inside of ranges, right? Your goal, again, if we look at the anatomy of a bullish candle, the wick always forms before the body. So we want to trade the wick and through the body and avoid the beginning and avoid the end. Okay? So that should be your main priority. Which days of the week within the higher time frame context, the higher time frame candle, and the range manipulation expansion are the highest probability days to seek entries. And that can help you identify which days of the week are likely to be the best days for you to put on risk in the market. All right. I hope this was insightful, kind of wrapping everything together into one system, one model. Again, you can change this how you like. It's not a one model fits all. If you're a scalper, you can scalp intraday inside of these expansions. If you're more of an intraday range trader, you can understand, okay, I want to trade Thursday and Friday, and I want to catch the low of day and hold till the end. If you're a swing trader, you can catch Thursday and hold till next week until the target's met, right? There's different ways of trading. It's not a one size fits all, okay? It's dependent on the trader who's clicking the buttons, all right? But this is by far, in my opinion at least, the best way to view the higher time frame and the best way to actually formulate setups, right? This isn't a pattern, it's a logic. The pattern of entry comes after the logic is formed from the higher time frames, right? Which is what makes the pattern high probability, all right? A lot of people get turtle soup messed up as some sort of pattern. You see a key level, you see a low, you buy it. And in reality, that doesn't work. That's not consistent. Sure, it'll work once in a blue moon, but when you're trading for 5 years with your own money, you're going to end it in a loss, right? So learning the actual characteristics behind why you should be trading this level, why you should be buying this low, why is today a high probability day to search for a setup, okay? That's what's going to put you and stand you out against all the other traders who are looking at it as a game and as a pattern, all right? But that's pretty much all I got for today, summarizing everything up in one. Again, I hope this was insightful, and I will see you guys next time. All right. Welcome, everybody, to the weekly review. Today, I'm going to cover over the trades that I took this week, my expectations for the following week, and then if you guys have any questions, we can cover those as well. So this week, I took one trade. It was a break-even trade. It was a short on euro, and I'll show you guys why. So if we're looking at market profile on euro on a weekly chart, we are seeing that on a weekly perspective, we are respecting bearish key levels, breaking lows, and rejecting highs, right? So on a weekly perspective, we are bearish, meaning every pump into a weekly level, I expect to reject, Okay, we saw that we had a weekly order block here, as well as this weekly order block is a daily breaker. Okay, so this wick here. Okay, so I expected that this was to hold to deliver to dollars higher time from target, which was eventually met here. All right, now if we go down to a hourly chart, we can see at the start of the week, if we mark 1700, okay, we pumped into this high, or into this key level, excuse me. We created a high and we souped it inside of London. Okay, so my entry was right around here. Stop loss above the breaker. All right, now the reason that this wasn't a successful trade was because price ranged, we expanded, we got good delivery, and then we came all the way back without taking this high again. Okay, so just unfavorable action, I would say, in general. This obviously is something you do not want to see when you're in a trade, is a expansion, a full retracement, shifting order flow again, and then for us to just sell. So this is a fine break even by me. Again, following rules. I guess for the new members here, we haven't talked about trade management too much, but we create a liquidity pool inside of a key level, we purge it, we shift, we create, and we tap opposing key levels. I break even, and then unfortunately this week we just had a very, very deep retracement. All right, not much you can do about that, but trade management was on point as always, and it was an A+ setup. All right, another good setup this week, I thought, if you were to take this, was the Tuesday short, just following order flow off of the 4-hour gap in the 4-hour order block. Nothing wrong with this as well. I think those were both fine setups. Did anyone manage to catch this move here? If it wasn't FOMC, you could have held it. Yep, I agree. Yeah, just one of those weeks where super deep retracement, price action is unfavorable, and not much you can do about it, right? As long as you positioned yourself correctly, that's all you can ask. And I think outside of it being FOMC week, Monday should have expanded here. There was no reason for this to shift up higher. Monday should have gone. Yep, control the input, exactly. All right, but that was it for this week for me. Now, looking into next week, so Forex is a little bit interesting. If we go to the dollar here, okay, so as you guys know, I am bearish on this year. This yearly candle, I'm bearish. So we have a few different key levels. We have a yearly order block, a quarterly order block, okay, which basically both coexist with this monthly breaker here, okay? So I'm expecting for one of these price levels to create some form of reversal lower, all right? Now, if we look at price currently on a daily chart, this quarterly order block does not currently look like it is going to hold. And to me, this is going to be where high of year is going to form. All right. Why do I say that? Well, we have expanded through this order block multiple times, and we're kind of consolidating at it, right? So instead of this looking like a reversal, this looks like the close of a bullish candle, right? So open, drop lower, expand, close. All right. So I will be expecting a further movement higher to this key level going into next week. All right, so if we can frame bullishness on dollar on a short-term perspective, we can say, okay, where can we be bullish from on dollar from? Well, we do have this order block, and again, order block slash breaker. This is in alignment with a gap here. And on euro, we also have a weekly order block, which again is also in alignment with that daily gap above here. Okay, So this is likely what I'm going to be looking to position myself in going into next week. Now, it is possible that instead of an open high on euro, we get an open low. And if we get an open low, that means on dollar, I'm likely to be looking for shorts inside of this key level. All right, so it kind of depends on how next week opens. We did have some over the weekend news about the Strait of Hormuz being closed again, which could cause some form of an opening gap. So that will definitely affect the analysis once we see where that goes as well. All right, but should be pretty clean again. Short-term bullishness on dollar until this yearly order block is met, and then likely to see some form of reversal starting to attack all of these 4-hour daily and weekly lows. All right. Any questions over Forex before I move to indices? Or does that all make sense? If you go on dollar, there's a gap above the breaker. Shouldn't stay unfilled. You mean here? I don't know what you're talking. Oh, you mean on the monthly? Yeah. Yeah, this gap, if this quarterly order block is to hold, this breaker should leave this high or this gap unfilled right here, which means this high shouldn't be met, which is why I'm looking for some form of reversal here. On dollar, once Monday hit key level, why you wouldn't expect a soup of the Monday candle? Because Monday's candle already had a turtle soup here. Right, when there's already a stop run inside the level, there doesn't need to be another one. Right, this is enough. Right, we put in a liquidity pool, we range, we soup. Right, this is the stop run that created this expansion. Right, so once this occurs, we should be in expansion mode. Right, you should be looking to sell. When we expanded through the high Monday, my mind went. Well, remember, Ben, follow and probe, right? What's the number one rule of order flow? It's follow and probe, right? Follow and probe market profile. So until this breaker gets expanded through, right? This is what your thought process should have been going into the week. I expect this to hold. Until this gets closed through, I'm going to anticipate that stop runs at key times are to hold, right? This should protect these highs from being taken, right? So if these are starting to get taken, if we're starting to push above this, that's the indication, okay, I'm wrong. But until that happens, you have to say, you know, profile is bearish. I'm going to expect these bearish levels to hold. Yep, I got you. All right. But, so pretty clear analysis on Forex. Let's go over to NASDAQ. NASDAQ also looks actually pretty good. I was looking at this last week, so I called this long down here inside this weekly gap, low that took a high. Again, just following probing order flow. I noticed that we had a breaker here that got tapped with a soup on, I believe this was FOMC here. But after this soup, this shift, this come back into this order block here, especially, this wasn't really a soup, but it would make sense for me that if we got one more stop run inside this order block and then ran higher. Okay, I would expect this next week again, just like all the weeks. Target opposing liquidity and expect likely higher expansions like this, right? But again, this daily order block here, and you can refine that obviously to the 4-hour order block. This looks like a good turtle soup candidate for the next expansion on NASDAQ. And then obviously if you want to see the same thing, clear this up. Same thing would be over here. We created this breaker here. We create a liquidity pool inside of it. Okay. And it is likely that possibly we could get some form of SMT like this while NASDAQ makes a higher high or a higher low, excuse me. All right. Let's go. What are the assets you guys want me to look at? Bitcoin. Oops. So for Bitcoin, again, I think there's two possible outcomes of Bitcoin, especially for everyone who's new here. Either the yearly gap or the yearly order block is going to create the low of year. Currently, this yearly gap, oops, we created a range inside of it right here, inside this yearly gap, but this current quarterly candle open high and stabbed into this breaker. So it wouldn't be the highest probability candle to want along the end of it, which is why I've kind of stayed out of Bitcoin here. Simply because you can kind of see, if we go to a monthly chart, this candle had open high, tapped the breaker, and expanded lower. So looking for some form of reversal here is a much lower probability than waiting for a new candle. So that's why I haven't personally touched Bitcoin. But just looking at structure, it does look like this order block is a possible candidate for the next target. So in the group chat was asked for AUD. Oh yeah, you're right. Well, AUD is the exact same thing. Let me remove this old alert. If we're looking for a higher target on dollar and then a possible reversal, you could be looking for a lower target on AUD and a possible reversal, right? Where could a reversal form on AUD if dollar is going to have a bearish reversal? Well, we have an order block, we have a liquidity pool, we have a range, okay? So you could be just like dollar, where I'd be short-term bullish until I'm bearish. I could be short-term bearish here until I'm bullish, right? Where could I be bearish from? Daily order block. Here's a liquidity pool. Short that until I could be bullish again. So a weekly order block, low inside of it, could be long. All right. Any other assets you guys want me to take a look at while I'm here? Should be a pretty clean analysis week. Again, we have to wait to see what the opening gap does on Sunday. Yeah, I can look at gold. Gold to me looks pretty bearish. Now we did tap into a quarterly level here. Okay, so we could possibly start seeing some movement higher here from this quarterly level. But even with that said, we are still respecting bearishness. Weekly gap held. This closed lower. This obviously is not respecting this daily CSD. So unless we get some form of actual shift, like let's say this high gets flipped, confirming that this is in fact the low, then I would say, okay, buy program has been initiated. We can start targeting these highs with confidence. But until then, it's just kind of iffier price action down here. Well, Jots, no one knows what the opening gap's going to be like. So that could completely affect dollar's bias, even NASDAQ's bias, right? You know, we'll have to wait to see later today. Good, man. It's good to take some time off the screens, but ready to get back. Ready to get back in the routine. Too much relaxing for me. I don't like it. Yeah, I know, Jazz. Yes, sir. Well, again, should be a nice week coming up. I have high hopes for it, high expectations. So, again, we'll see what the opening gap brings. I'm going to close the OBS here.
All right. So, welcome everybody to the weekly review. I'm going to cover over the trades that I took this week, why I took them, and then we'll start getting into my expectations going into the next week, what my plan is, and what I will be looking for. All right. So, this week I was 3 for 3. I took 3 trades, 3 wins. I took 2 on Euro, 1 on CAD, and I'll talk about those now. So, if we go on over to dollar, right? So everything starts with dollar. And what I wanted to show you guys, right? If we think in terms of market profiling on dollar, what are we seeing right now? So dollar on a monthly chart is rejecting highs and breaking lows. Okay. So it is reasonably expected that we are going to continue this until proven wrong. Okay. Therefore, the fact that we are above monthly highs and running into a monthly breaker and also a yearly order block tells me the likelihood is that price is going to continue this trend. Now, if it doesn't, that's okay, but simply following and probing order flow, it is likely to seek some form of reversal here. All right. Meaning that weekly order flow and daily order flow is likely at some point to begin a shift. Right. That's the framework that I'm working within right now. Right. Until this key level is broken, I will be expecting that. Okay. So within the idea that dollar is likely to go lower, I'm seeking buys on euro. Okay. Now, what key levels does euro have in play? Well, we have a quarterly FVG right here that we're running into. We have a daily breaker inside of this FVG. If we go over here, low, high, lower, low, close above, right? This confirms this candle as a breaker. If we drag it out, okay. So the fact that dollar is ready to deliver lower is telling me that I want to be seeking buys inside of key levels on euro. All right. So that was the idea going into the week. Now, how did I trade this? Once dollar hit the yearly order block and started delivering higher here, okay, I took a long entry here. Okay. Why here? Because this was during the kill zone. So it was during New York session. It was the first time we had an hourly low put in and a sweep of it. Okay. At the same time this was being swept, GBP took out its low inside of its relative key level, the monthly rejection block here. Okay. So the fact that this was all happening at the same time gave me confluence to win a long euro here. And the same time I longed euro, I simply split my risk and I shorted CAD as well. Also inside of course, a key level above a high. All right. So that was the context behind the setup. Now, my third entry and my final entry was once we created a daily rejection block off of this low, I traded this soup here as well. Okay, 15-minute low. We range, we come into this. After New York had an expansion, so I was expecting some form of OTE. Okay, we have a soup, a shift in structure. This is the entry right here. All right, so that was the idea going throughout the week. Now, some interesting key levels and lows chosen on EU trades. Yeah, and I'll explain it in a sec. So it's obviously it's going to be a bit more difficult when you're trying to catch a low of year, right? Or you're trying to catch a high time from reversal. It's going to be a lot more difficult to catch the very bottom than if you're catching some form of like 4-hour continuation, right? Because it's a much longer term setup. Therefore, the number one, the stop loss and the time that it takes for an actual reversal to form is going to be much more, right? So looking at price right now, it's not clear to me, and this was kind of the question I was asking myself going into last week, was when is the reversal going to form in terms of time? Okay, because this is the end of the month. We have 2 days or 3 days, I guess, to the end of the month. All right. So is it likely that the reversal is going to form here, or is it going to wait for next month? Okay, so that's kind of the question I've been asking myself. Right now, how can we infer that? Well, once we tap the level, is the level producing key levels for expansion, or is it ranging? Right? If it's ranging, it's likely that the next monthly candle can open, soup, expand. Right? And looking at price action now, it's not very clear in the fact that we're expansive. Okay? This gap is still holding. We had a large rejection. Okay? There's no clear shift off of this low. So, in my opinion, I think that price action is likely going to range here for one more soup of this low, or SMT, right? And obviously, we would see the exact same thing over here. Some form of range, consolidation, a soup, and a dump, okay? And I'm framing that based on time. All right, does that make sense to everyone? Why I would be cautious going into early next week, right? Even though you're bullish, there's different parts of trading, right? You can have bias, but you have to be able to know how to align yourself with that bias, right? If price is bullish, but you're trading in a range, you're still going to lose, right? So you have to understand how to actually apply that bias in the correct way. What's for me now, and even remember exactly 24th of October, too soon what time of period didn't align my eyes. Yeah, lower time from price action isn't supporting the idea of this being the low of year yet, right? So I'm cautious until, possibly if we get a clear shift, then I can start trusting this low. But until then, I want to be cautious of a next week sweep, all right? And with NFP on Friday and the new monthly candle opening on Wednesday, it's very possible that we get something, like this. NFP, dump, and then pump. Okay? So that's the idea behind Euro this week, okay, and going into next week. Of course, GBP as well. GBP has this monthly rejection block here. I want to see if next month wants to open low, take out some lows, and then deliver higher. So same kind of thought process over here. That's why I didn't push it this week. Seemed like a clear. Yep, exactly. Yep, it's important to understand, especially for everyone new here, is you never want to just think of something one directionally, right? So you don't want to think, oh, I'm bullish, so I want a long. You have to think, what are all the possible outcomes of price, right? Just because I'm bullish here doesn't mean price can't range and soup next month. Doesn't mean price can't consolidate. Doesn't mean price can't soup here and just expand. So it's important to understand all the different possible outcomes and then weigh them towards what price action is actually doing. All right. Let's go into NASDAQ. All right. So NASDAQ is quite an interesting one. This is what I saw last week. I know some of you guys traded this. I saw that US 30 took out this high and we started rejecting it. We took out this high and we started rejecting it. If you guys saw the bias and order flow video, when we reject a high, it's likely we seek some form of low before continuing higher. Okay, so when we get this SMT on this high here and it's a rejection, it tells me that NASDAQ is more than likely going to seek some form of low, right? Which would invalidate all of these key levels in here. And we'd be seeking sell side. Okay, so that was the idea going in to the week. We had a stop run, a close below, and a daily gap here. Okay, and this was a super clean short. No, I fully got out of NAS, dude. I only took that on prop, not my live, which is why I guess I can break it down quick. I did take a position on NAS, but again, it wasn't on my live account. It was just on prop. But I did take this daily gap soup in here. 8:30 news manipulated, created a gap, and I traded this gap down to this low. Okay, super simple. Bias, lower. We had a turtle soup with news, created a 15-minute change in order flow, entry, target. Yes, that would, Mayor. I don't usually trade NASDAQ, which is why I wanted this to be a shorter term position. Okay. But going into next week again on NASDAQ, I would expect delivery towards these lows. If we're delivering towards these lows, what key levels do we have? Well, on a weekly chart, we have an order block. This order block is right above this high here, and it also aligns with this breaker. So this looks like a very high probability setup, in my opinion, that price could possibly range, manipulate, and then deliver lower from this weekly order block here. Right? I would be careful. I'd watch if price is likely just to start dumping through these lows, then a possible continuation inside of a gap or something would work as well. All right. Let's go to gold. For those of you who are insane and trade gold. For me, gold is just bearish. It's a little bit more difficult to analyze a market that is just straight up, straight down, because there's no real structure to tell you how deep this retracement can go. So, because yes, we are in a quarterly gap here, but it hasn't produced any sort of worthwhile expansion from here. So I would expect just a continued sell-off until proven wrong, right? So just following probing order flow, because we respected a weekly, a daily's bearish. Okay, we rejected this low, likely some form of retracement. Okay, but overall, just not the cleanest price action. But if you are to trade it, I would just expect continued move lower. And then last but not least, let's go to Bitcoin. Bitcoin's an interesting one, I think, going into this week. Or excuse me, not this week, this month. So like I've been telling you guys, Bitcoin is either likely to bottom in this gap or in this order block. Okay. These are the two areas of positioning that I'm looking for a longer term positioning higher. Okay. If we go to a quarterly, this quarterly candle opened high, rejected this breaker, and is delivering lower. So you should not seek buys inside of this candle. I don't believe that this candle is going to continue higher. Right? And it looks to me that because of that, this is not a soup. Right? Now, yes, we are rejecting the low for now, but this candle was an open high, delivered lower, and is closing. Okay? So, in my opinion, I don't think this is a great time to long. Okay? Now, going into next quarter, we'll see, especially if this possibly closes inside, but I am favoring right now that this is going to be the target, that this low is going to be the soup, and that this is where the higher time frame reversal is going to form to deliver higher from. Okay. So this is kind of the framework going into Bitcoin. So if you were to short, we have what? We have a monthly order block that's going to be created, which will be above this high here. So this could be a possible short idea, something like this. All right. Any questions over any of those? For trades this week, how did you manage it? Good question. For my trades this week, and this is something I've been doing recently, is I don't break even. Okay. Why don't I break even? Because my invalidation point, wherever I'm putting my stop loss, it's the invalidation point for my key level. Okay. Until my targets are hit, my key level isn't invalidated, right? Now, when price starts to expand and we start meeting opposing targets, right? Like we start filling in this gap, we start reaching liquidity pools on a lower time frame. Okay. That's when I start monitoring, should I stay in this position? Should I partial? Right. For example, I'm fully out of this position here. Okay. After I saw that we went above this high, we closed below here, and that we weren't expanding, I closed. Okay. So it's more so I'm just trusting the key level. And then once we get an expansion, I'm seeking and trying to understand if I should stay in this position or if I should hold. And if lower time frame price action is supporting my idea or not. Yes, shots. Yeah, I can check that, Leo. Is this like an AI coin? Looks good though. We have a breaker. Low. Yeah, looks good. For a pump higher here. But again, right, especially for like alts and stuff like this, they all run off of Bitcoin, right? So if Bitcoin's going to go lower, these alts are also going to go lower. So that's one thing I would say is it's important to have those in combination. Yeah, what about GBP CAD? All right, if I were to analyze GBP CAD, I would say on a monthly perspective, we're bullish. On a weekly perspective, we're bullish. Why? We're rejecting lows, closing through highs. Okay. What key levels do we have? Well, we have a weekly breaker here. Okay. Inside of this weekly breaker, we have a stop run here, right? Look, I'm not using CRT as a pattern. I'm seeing, does the CRT have a stop run inside of a key level, right? If it does, that means that this low is sponsored, right? So instead of looking at this as a pattern, I'm bullish and I expect bullish key levels to hold. We have a bullish key level. This low right here is a stop run inside of that key level and a shift. Okay, now I trust this to hold, right? Now that I trust this to hold, how can you trade this? Well, what key levels has this created? Well, not much, right? Actually, it's quite consolidative. Okay, so because there's no true key levels in the chart right now, I would avoid trading this, right? There's no sponsorship. Really, the only key level is this daily rejection block all the way down here, right? So because a lack of key level means a lack of sponsorship. If there's no order block for smart money to buy from, we're going to be sideways, which is what we're seeing, right? Again, just because you have a bias doesn't mean you can trade that bias. Bias and alignment of that bias are two different things. You have to have both in combination to successfully, make money, right? Just a bias isn't enough for you to trade a chart. You have to be able to understand how you can get into that bias. And with this chart, there's no key level sponsorship to tell me I can trade from here to here, right? Versus Euro, we have the daily or the quarterly gap, the daily breaker. We're bullish. We're seeking soups for higher, right? There's context behind why we can trade this bias here versus that chart. Hopefully that makes sense. Right? Anyone else got any questions while I'm here today? Yeah, anytime, man. do a quick Q&A. Where's your SO for your first EU long? Good question. Okay, so whenever you, and I really want to put an emphasis on this because I truly believe that your invalidation level, your stop loss, is way more important than your entry. Entry honestly doesn't matter. You guys are like, I've gotten many messages how I enter or whatever. The entry does not matter. If your stop loss is in the correct place, you can literally set an alarm and just enter. Entry honestly does not matter. Stop loss is important. Stop loss is, I always think of it like this. Whatever key level I'm trading, I want my stop loss at a level that if that key level is invalidated, I'm wrong. But what you don't want to do is you don't want to have your stop loss at a level that you can get stopped out, but your key level still holds, right? So I'm always thinking, where's an actual invalidation point for the level that I'm trading? So if I go over here on Euro and I mark the daily breaker that I was trading here, okay? So I'm trading this breaker. I'm trading the soup of this low, okay? So what would be an invalidation point for this breaker? Well, if I go to the left here, okay, what's below this breaker? Well, we have a low protected by a breaker, and it's also an intermediate term low below this range, right? So this was my determined stop loss point for this key level. So when I took a soup here, of this low, that's where my stop was, okay? And now I want to tell you guys this again. When you're trading yearly reversals and higher time frame reversals, you can't expect to have the same stop loss as if you're trading, a next day continuation on an hourly order block, right? It's you have to understand there's different times for smaller stop losses and there's different times for bigger stop losses, right? You have to understand what level it is you're trading and how you can position yourself within that level instead of thinking every trade you take can have a 5 pip stop loss, because that's just not unlikely, right? Again, if I'm trying to catch low of year, my stop's going to be a lot bigger than if I'm trying to catch a 4-hour order block continuation, right? That's just how it is. Yeah, anytime. All right. Any other questions while we're on here today? Want to make sure you guys are all ready for next week. Most of the times it stays a week after, it's going to be better regrowth. Yep. All right. Well, it looks like for the most part, you guys all understand. So I'm going to wrap up the review here. I hope it was insightful. Before we do that, hold on. Alberto, when you use the body or wick of the breaker. So this is pretty much the same for order blocks and breakers. Whenever the breaker or order block has a large body, you always use the body. 90% of the time, I'm using the body, okay? But if the breaker or order block has a very long wick, that's when you want to use the wick, okay? But still, 90% of the time, I'm going to be using the body, all right? Unless it has a very large wick, okay? So that's kind of how I differentiate, all right? But I hope you all have a good rest of your weekend. Let's make some money this next week. We'll see what price action has for us come market open. And we'll stop the recording here.